under terms of its charter. So recognition. Now, when we set up this corporation, we are typically going to authorize, Nico, more shares than we plan on issuing. So maybe we authorize 4 million shares and we choose to issue 2 million shares. Let me let that person in. And so, boom. And so we're going to issue of these shares. Test question, issued shares are shares that have been placed with investors. So, boom. So those of you just joining us, the way this works is first come, first serve. Put in the chat whatever you'd like. I see Stacy's up next, and then we just knock out in order what people want to talk about until our session is over. And so maybe we choose to issue 2 million shares. And Nico, we would not expect early in the life stage of a company that we have any treasury stock. Now, there are two things that are associated with corporations that have excess capital, and those are dividends and treasury stock. So treasury stock are shares that have been purchased in secondary transactions from previous shareholders. So right now, Berkshire Hathaway has been making a tender offer to its shareholders to buy some of the stock into the treasury. We wouldn't expect in our example that we have any treasury stock because we're relatively new. I would know that treasury stock pays no dividends and has no voting rights. And so here we have outstanding. That's issued less treasury. We have no treasury. And so, boom, we have 2 million shares outstanding. And so let's say that my friend Nico owns 200,000 of the 2 million. He owns 200,000 of the 2 million. And as we expand our business, we decide that we need some more additional equity financing. And so we decide that what we're going to do is issue the other 2 million shares. So Nico, you own 200,000 now of 2 million, 10%. And after we issue those 2 million shares that are authorized but have not been issued, and now we are, if you don't buy new shares, you're going to get diluted. You're going to own 200,000 shares of 4 million. You're going to go from 10% ownership to 5% ownership. And, this is very testable. You have, test question, a preemptive right. A preemptive right is your right to maintain proportion ownership. And what that amounts to, Nico, is the first right of refusal on the issuance of new shares. Let me put that over here. And as we mentioned in the live stream, that amount, the way we use this is the way we do it is a rights offering. Let's put that in a different color. And so if I was your broker, I'd call you up and say, hey, that company you're invested in? He says, yeah, Dean, I own 200,000 shares. I said, well, they're going to double the number of shares outstanding. And so, if they can raise the money from the existing shareholders, in fact, not only can they raise it, the most likely people to provide us the additional equity financing are the people that are already in the hot water with us. And so I call you and say, Nico, would you like to maintain your proportion ownership? Because if so, you're going to have to buy 200 of the new 2 million. To have the same proportion, you're going to need to have 400,000 shares instead of your existing 200. And it makes sense that rights, test question, are short term because the issuer needs the money and they need it like now. And rights, of all the derivatives you're tested on, rights, warrants, and options, rights are the only ones that at issuance have intrinsic value. So, right now, let's say the market price of the company is $5 a share. I'm just making that up. And let's say that the subscription price is $4. Again, they're going to let you buy it at less than the current market price. That's to give you an incentive to participate. And remember, it's passing on the savings from you to buy this. So test question, the subscription price is going to be less than the market price. And again, the number of rights are going to be given here. But as I said, if Nico has 2 million shares, he has 2 million rights. And so, 2 million rights would be, he needs one each share. So the way we're going to do this is we're going to take 5 minus 4, and that gives us $1. And then we're going to divide that by the number of rights needed. And in this case, it's going to be 1 because we have to be able to maintain that same proportion ownership. And I say, okay, so each of these things are worth $1, each of these rights. Now, the distinction about cum, with or without rights, Nico, is, remember, there's 3 things that can happen to derivatives. They can be traded, they can be exercised, or they can expire. And I would say, well, if you don't want to exercise, let's sell it to someone else. And if it's trading cum, that means they have to be able to buy the stock before they can participate in the rights offering. And that means it's going to be worth less. And so here, that would be +1 if we did that. And as you can see, they're worth less if you have to actually buy the stock. They're going to be worth, in this case, 50 cents. So that is how we calculate the theoretical value of a right. Now, Brian agreed with me. I haven't had anybody in years tell me they've actually had to do this. Right? It's mainly, it's short term, it's exercisable below. And then the main test question is, can you distinguish that from a warrant? And warrants are long-term, exercisable above the current market price, right? So I say, hey, Nico, I have a unit for you today, some units I'm offering. A unit is more than one security offered together. And so I'd like to share with you the opportunity of these 2 securities. These are a bond, and then as an incentive to buy the bonds, we have warrants attached, so we'll let you buy the stock for long-term above the market price. My favorite example I use in all my lectures is in 2010, Berkshire Hathaway had 700 million warrants to buy Bank of America common. And the strike price on that was $7. At the time, Bank of America in 2010 was $6. In 2015, when Bank of America was $25, Berkshire Hathaway exercised the warrants. And they bought 700 million shares of Bank of America at $7. Woohoo! They got those warrants as an incentive to provide financing during the crisis, the financial crisis. Unlike the live stream, Nico, audio does work. Is there anything else you'd like me to add to that before I move on to Stacy's question?
No, thank you. That's all. Thanks.
Okay. All right.